Alrighty, so in today's video breakdown, we're going to go down the rabbit hole, go over fundamentals, do a weekly recap, and then forward project into this upcoming week. Go over some very interesting details that I've paid attention to by tracking price action in 2024 so far. We're going to piggyback off of this post that I made, and it's because I've seen a lot of influencers on the internet calling for a bull market continuation and calling for a continued downwards momentum in the total cryptocurrency market. Individuals on the internet not really understanding that what's going to determine that are fundamentals. It's not just going to be a continuation move to the upside, and it's not just going to be a continuation move to the downside. Fundamentals and risk on, risk off market sentiment is going to determine that. And this week, I'm going to show you in today's video breakdown is going to play a very determining factor in that role based off of historical data and based off of what the market has most recently done. So I said to you guys in this post, markets are playing ping pong off of jobs reports and US data. And I'm going to show you that in today's video breakdown. It's very easy to pay attention to. Yet again, this is the information that 95% of manual retail investors and individuals that are dollar cost averaging in the space don't want to pay attention to. They just want to always assume that XRP is going to be $100. Okay. So US disinflation continues for now, right? We saw disinflation via the month of June where we had CPI, PPI, and core PCE figures come out, but Fed speakers are still holding a hawkish to neutral tone, weighing on rate cut bets. Last week, we saw a significant amount of Fed speakers come out with a more hawkish tone, pushing back rate cuts and saying that they'd even consider hiking rates if cooling of US data doesn't come into fruition and disinflation continues. Right? So just keep that in mind. Those perspectives are still on the table, bringing more strength to dollar. I said it's not hard to see. In focus this upcoming week for market direction are key PMI figures, Federal Reserve tone, labor market data. Simplicity is key. So again, I'm just showing you all here in the CYPRX private community, we called this pullback. We said that in order for the market to break out of this accumulation phase and break past $2.7 trillion back at the beginning of June, you can see this recording was from 1 month ago, May 23rd, 2024. We had projected that the market was going to pull back due to optimistic US data and strength in the dollar, creating a more risk-off market sentiment as investors started to price in a higher for longer interest rate environment via the tone from the Federal Reserve speaker, and all the upbeat US data. Okay. Now, yes, disinflation is continuing, but we are still seeing a strong US economic environment, especially considering that other major G10 jurisdictions are not performing as well as the United States. For example, in the Eurozone, there's been dwindling US economic activity. In the UK, there's been dwindling economic activity. And all of those things, when there's less demand for other currencies like the Great British Pound or the Euro, it tends to drive more demand for the US dollar. So there's many other factors driving strength the dollar and less of a demand for risk assets, okay? So we're just going to do a market recap. Then we're going to get into the forward market projection. And then I'm going to show you guys the interesting things that I found surrounding fundamentals and what I meant by telling you all in this post that markets are playing ping pong off of jobs reports data, which is why I think this week, considering we have NFP figures set to come out with non-farm employment change and unemployment rates set to come out on Friday, is a very important thing to be paying attention to. So market recap last week, the total cryptocurrency market remained relatively flat, staying suppressed below $2.3 trillion, as we mentioned in previous private Zoom call recordings. However, around May 2024 lows, this was due to the dollar's strength, which remained in the high 105s and briefly broke above the 106 last week. On the economic front, there was signs last week of disinflation with core PCE index showing lower month-over-month and year-over-year inflation figures. However, this was insufficient to weaken the dollar, as other aspects of the US economy demonstrated strength and resilience compared to other G10 countries, as I mentioned. For example, real GDP last week increased at an annual rate of 1.4% in Q1 2024 in the United States. The unemployment rate also slightly declined. The Chicago PMI figures also rose, and U.S. consumer confidence exceeded expectations last week via the report in June. While disinflation is occurring, multiple Federal Reserve officials last week maintained a hawkish tone, supporting a stronger dollar environment. They reiterated that most Fed members favor higher interest rates for an extended period of time, with some still considering a potential rate hike if further economic cooling is not observed. Economic resilience and hawkish Fed comments strengthen the dollar because they indicate confidence in the US economy and suggest that interest rates may remain high. This environment makes risk assets like cryptocurrencies less attractive comparable to the United States dollar, right? So just keep that in mind. That's a market recap. We pretty much consolidated at around these lows from the previous month of May. Significantly enough, that is exactly where, like I mentioned, I'm going to go into how the markets are playing ping pong with US jobs data. Right here, once we get into the fundamental side of things, that is exactly where the market bottomed out at the beginning of May, roughly the first week, where we had a dovish tone and sentiment from Jerome Powell, bringing back rate cuts or rate cut hopes to the table, coupled with a downbeat NFP report and a miss in all labor market figures across the board the first week of May. You can see the spark that ignited in risk asset sentiment. And we'll get into when the market turned around. Significantly enough, when the market turned around and started selling off at the beginning of June, that is when we had a upbeat labor market report showing strength and resiliency in the US labor market, coupled with the second week of June, a more hawkish tone from Jerome Powell, opposite of what we saw at the beginning of May, weighing on risk assets and shifting risk sentiment, right? So just keep that in mind because this week, remember, you can see here the bullish environment that a downbeat NFP report and unemployment rates brought to the market via the sentiment. And you can see what happens when an upbeat report comes out, showing strength and resiliency in the US labor market and what strength that brings to the dollar and how that weighs on risk assets. So this week, once we get into the fundamental report, you can start to formulate your brain around what environment we would need to see in order to see a recovery in risk assets and not just be like these bullish moon boys or these pessimistic individuals that just think the market is going to go in one direction and understand that in order for an either up move in crypto to unfold or a down move in crypto to unfold, it is going to require fundamentals to unfold and for the market makers to react to those fundamentals and adjust their algorithms, right? So let's go over this week's market update and fundamental forecast. Heading into the first business week of July. Remember that July 4th, this week is a bank holiday, so make sure that you all are paying attention to that and adjust your trading strategies accordingly. This week, key economic data will be in focus. We have important Fed speakers throughout the week, along with the FOMC meeting in minutes. Remember, that is different, completely different from the FOMC meeting itself. They pretty much just reiterate to the market what they said at their last FOMC meeting, which is what I'm expecting this week. Them saying that, yes, inflation is coming down, but the overall economy is not cooling with disinflation. So we're still seeing a hot US economy, but yes, disinflation is happening. We just need to see weaker jobs data and weaker economic activity in the US before we fully decide to cut rates. That's what I think they're going to say to the market this week, which is literally pretty much cut and paste from what they said at their FOMC meeting in June. Okay, where we'll pay attention to their tone and monetary policy and their perspective on the US economic health. So I said that in the report. Key PMI figures are also expected, but the most crucial data will be the labor market reports at the end of the week, including unemployment rates and non-farm payrolls, i.e. NFP. For a recovery, this is the scenario that we would all like to see. So we'll go over this one first. For a recovery in risk assets, so for all the bullish moon boys out there that want to see a recovery in risk assets and think that this is the bottom, in order for that to be solidified, this is the environment we would ideally and logically need to see. We would need to see further cooling in the US economy, reflected in higher unemployment rates, and a decline in NFP figures, which would likely suppress the dollar strength and support a risk-on market environment. If we could couple that with some downbeat PMI figures missing the mark, those things would all drive sentiment towards risk asset buying and weigh on the strength of the dollar. So I have little tiny cheat sheets over here for you guys typed out. So the more favorable environment this week for recovery in risk assets, and I'll send screenshots to you guys in the private Discord. We would need further cooling in the US economy, higher unemployment rates, a decline in NFP figures, suppression of the dollar strength, so dollar below the key 105.5 key psychological levels of the 105 flat, support in risk asset market environment sentiment, okay? So if we can see that this week, as mentioned in this previous call and others after it, This is most likely, to some degree, going to turn into an accumulation schematic, and we are going to start to recover from June's market downturn, possibly breaking above $2.3 trillion and making our way back to 2.4 to $2.45 trillion, coming and engulfing and starting to take out these lower highs, just like we did in May. So if we do see downbeat jobs reports, weakening US economic data, maybe even a potential dovish leaning Federal Reserve because of the disinflation observed in June, right? And a risk on market sentiment, we can start to possibly see a recovery and making our way back to the $2.4 trillion threshold, breaking above these intraday highs. Double bottoming out here at these lows, creating a platform just like we did at the beginning of May, and alleviating some of this downwards pressure. But in order to do that, we need to see that environment created. And you guys now have an idea of what that environment would look like, right? On the opposite side of the spectrum, what would diminish the market sentiment and crush retail traders, right? Because again, the vast amount of individuals in the retail space have no idea why their assets are down in value, okay? So if we do see this week stronger PMI figures, continued hawkish comments from Fed speakers, and robust labor market data, just like we saw at the beginning of June, this is most likely going to further delay the hopes for rate cuts, strengthen the dollar, and increase selling pressure on riskier assets like crypto. So in a scenario where we see that environment created, and again, I created a cheat sheet for you guys up here with little tiny side notes. I'll screenshot the scenarios to you all and send it to you in the chat so you have it for the week. Delayed rate cut hopes, stronger PMI figures, hawkish Fed commentary from their FOMC meeting in minutes, robust labor market data showing strength and resiliency in the US labor market, and further strength in the dollar, breaking above the 106 and holding well above that, would most likely increase selling pressure on crypto. And in that scenario, if we fail to break above these intraday lower highs, we fail to start to recover back up into $2.4 trillion, and we don't start to take out this bearish structure that we've just most recently created, most likely what's going to happen is this is going to turn into more distribution. Sellers are going to overpower buyers, and we're going to see more liquidations events and most likely see price action lower to some degree in the total cryptocurrency market cap, most likely taking out the May lows. If we're not going to target intraday highs and see a bullish recovery, the next pocket of liquidity that exists in the market where leveraged traders have open positions is 110% beneath these May lows. So if we do not flip bullish and we see an improved market sentiment and risk assets, we see supporting data weighing on risk assets and strengthening the dollar, we can assume failing to break higher and create bullish order flow is going to result in a further downwards momentum in crypto assets across the board. Okay. So this is what we need to be paying attention to this week, shifting our strategies according to market sentiment as the data develops, playing the role just like the central banks do. How many times have you listened to FOMC meetings where they continuously say we need to be data dependent? That's one characteristic trait that a lot of manual retail traders don't have, is they're not data dependent. They marry a bias without understanding that these markets move day to day, week to week, month to month, quarter over quarter, year over year, and that sentiment can change on the drop of a dime depending on what environments are created for these algorithms to benefit and profit from, right? So with that in mind, don't marry a bias. Don't just marry a bullish bias. Don't marry a bearish bias. Understand how to adjust to the market environment that is created for us, okay? With that being said, you guys have my updated DCA levels. Some of those areas of interest have already come into fruition and been met and seen slight price appreciation compared to where we're currently at in the total cryptocurrency market cap. With that being said, don't forget that this week I will be in the process of moving. So this will be my last Zoom call for the week until I get situated in Texas. So I appreciate you guys for tapping in. And that is my fundamental breakdown for today. So that's what I meant, just a full circle by the market is playing ping pong off of the jobs reports data. You can see clear as day that a downbeat jobs report like we got at the beginning of May, coupled with dovish commentary from Jerome Powell, created much more of a risk on market sentiment. Couple that with some dwindling US economic reports in the month of May, also favoring a risk on environment. That was all pretty much pooped on as we rolled over into June, because right when June started, we saw upbeat US economic data rolling over into June. We saw strong jobs reports, unlike the weak jobs reports that we got at the beginning of May, showing strength and resiliency in the US economy. We got hawkish Fed commentary, and then we got more strength in the US data. US output growth hits 26 months high in June, prices pressure cools, right? So you can see the bullish fundamentals for the dollar weighing on risk assets. So let's see, we already got disinflation down here at the bottom of this low. So that's one thing holding support and optimism in risk assets right now, is that lower inflation reading, which is the core PCE price index from last week, the primary inflation measure for the Federal Reserve, came out lower, showing signs of disinflation. So that boosted market sentiment surrounding rate cut bets. That brought rate cut bets back on the table. Okay. So let's see if these fundamentals unfold in favor of risk assets this week, like we would all like them to. But again, be reactive and adjust your bias accordingly. Other than that, I'll leave the floor open for questions if there are any at this moment in time.